Good morning, good afternoon, or good evening. Welcome back to the channel. And if it's your first time, warm welcome. And please hit the subscribe button to support this channel. So, as you have seen in today's video, we are going to talk about financial return. What is return in finance? But before explaining what is the return, I want to give you some hint related to the previous video. In this last video, I give you an assignment where we have to start a business. That's one of the tasks of our assignment is to start a business. But to start a business, I want to give you first of all a hint, something that can help you to perform well in your business. So the things that I want we understand here, it's what we call the market. Because many times people, they get the capital and then they start investing blindly, just something they copied from their neighbors or from their friends, but without understanding what they are doing. You have to understand first of all the market, because if you are selling winter jackets in Sahara, so no one is going to buy them. So then, what is the market? In the market, you will find different definitions, but there are some legal things you read in the books. But here, the definition I want to give you, just an explanation, is something very easy. You know, in this channel we use simple words to be able to put things into practice. So in the market we have two groups. There is the first group, which is a group of buyers, and those people who are buyers, they are just ready to buy. That's the first group in the market. And the second group, which is the most important here, it is the group of sellers. And those people, they have something to sell. So the first one, they want to buy, but there are other people who have something to sell. So you must have something to sell if you want to make a business. So after understanding what the market is, just a group of those two people, maybe I can ask you, in which group do you belong? Are you only in the group of buyers or you are in the group of sellers? Please join the group of sellers. And then we have to understand something also, that most of the time people, they confuse a business and a company. So also in easy words, I can explain a business as, when you own a business, just you are selling someone's products. The products you are selling are not yours. Often businesses are small and they are not, not independent, because if you own a boutique in which you sell eggs but you don't own a farm, so you have to buy first of all eggs from someone who owns a farm. Maybe he has 5,000 chickens, but you are selling his products. So you own a business, you own like a boutique. While a company sells their own product. When a company can sell their own products, if you own a boutique and also you have a farm and you are selling in your boutique things you produce in your farm, so it's getting a company, it's becoming a company, because it's, in that case, it's bigger, while a business is often small. So I hope with this it's clear, we understand what the market is. Now what is a business, what is a company, then you know which one you can choose. And then let's jump to today's topic, which is financial return. So what is the financial return? So just the financial return is the money you make or you lose during a chosen period on considered a certain investment. So when you are making an investment, there is the value of your investment at the beginning for a certain period. There is the end of the period. Your company, your business has your investment has another value. So the return is going to be the price, the final price of your investment. That means the price at the end of that period you have chosen. Maybe it's 1 day or 1 week or 1 month, minus the initial price. That means at the beginning of that period, the value of your investment. That means the initial price dividing by the initial price. You will end up with a number which can be either 0, positive, or negative. So when it is positive, of course you smile, while when it's negative you start worrying. So you can see that this denominator, if the final price is higher than the initial price, the return is positive. Here is, for example, when you are producing your products at, like, let's say 200 and you sell them at 250. So that means the final price is 250 while the initial price is 200. You will see that the return is going to be positive, which is good. But it's better to make things clear using an example. In this example, as you can see, the column of prices is just the prices of the shares in our time series. We remember we had an example of how the prices of the shares was changing. These are real data of one of my investment. So here the return, as you can see, we have 2 weeks, 5 days per week from Monday to Friday, and the prices were varying like this. And the corresponding returns are just on the first day. Of course, you on the beginning here the return doesn't exist because we don't have the previous one. But on the next second day is where we start having the first return, because here the period considered is just 1 day. And then because on the first we have 100, the initial price is 105 and the final price is 105. That means here the return is 0. While for the third day we get now 106.44, the corresponding return, which is the second return, is going to be calculated using just the second and the third one. We take the second here as the initial and the third 106.44 as the final, and the corresponding return is going to be 0.013714, etc. You can continue calculating the other returns like this. And as you can see, the returns they give also another time series. Graphically, we can have it like this, as we see on this figure. Another thing here we have considered in this column of return, we have just the period is 1 day. In case, for example, the period is 7 days, that means we are going to take, for example, here the first day as the initial and the final is going to be 109, which is on the 7th here, and the corresponding return is going to be computed by just the 109, the final, minus 105. We divide by the final price, which is 105, and we will end up with this. Another example we can take, in case of 5 days, a period of 5 days. For example, if we have a look on these 106 as the final price, and the initial price, we take the Monday here, 108.64. The corresponding return here is going to be negative. That means if you have, for example, if you have bought the share at this price and you sell it at this price, that means you are going to lose, because you see the return is negative. While if you have bought it at 105 and you sell it at 109, as you understand here, you have made one, because here it was in Swedish krona, you have made 4 Swedish krona per share, but the return is not 4, is 0.038, and so on. I hope with this example you understand how you can compute the return and you understand what it means. But the remark I can mention here, return is not interest rate. I will explain interest rate in the next video. Now it's time to thank you for watching till the end. I hope now things like market, business, company, and return are clear. And next time we will talk about interest rate. And thank you for watching. And once again, I wish you love and money. Remember to hit the subscribe button. And if you have comments, questions, and suggestions, go down and write in the comment section below. And also I'm inviting you to watch other previous videos so that we continue the journey in this series, Finance Engineers, together with the same understanding on things.